Hello and welcome to a recap of our lecture on APV. Now this is a very simple way to evaluate projects if you've done a few examples and you know the process to go through. So when do we use adjusted present value? Well, we do it if the capital structure of the firm changes. So if we have to issue debt or equity to undertake the project, APV will be the correct choice. So if the capital structure is by doing the project, or indeed, of course, if the examiner says so, even if you don't think that's probably the correct way, because you may be asked to calculate the APV and then criticise it. So just do it if the examiner says so. You can criticise it afterwards. So why do we do adjusted present value? Well, it evaluates the investment and financing decisions separately. So we evaluate our investment decision firstly, and then we evaluate the financing separately, and we bring them both together in the APV calculation. So the procedure to do this is that we need to ungear our cost of equity. If you're given betas, we'll ungear the beta using the same formulas we did in the last lecture. So we fill it into CAPM, and that gives us our ungeared cost of equity. If we have no betas given to us in the question, we'll need to ungear the cost of equity directly. So if no betas are given to us, we're going to ungear the cost of equity using this formula. So we have KEG equals KEU plus KEU minus KD, all multiplied by the capital structure VD over VE. So we've used this before. We used it to calculate the geared cost of equity, but this time we're calculating the ungeared cost of equity. So we're just flipping it around a little bit to get KEU, and we did that in illustration 1. Once we've ungeared the cost of equity, we can evaluate the investment decision first of all, and we'll do that using that ungeared cost of equity. So we calculate our NPV as usual, and for our discount rate we use that ungeared cost of equity. So use our ungeared discount rate to give us what's called our base case NPV, and that is our investment decision evaluation. So we'll use that base case NPV in our APV calculation later on. The next thing we need to do is evaluate the financing decision, and there's really 3 steps in this. Number 1, we look at any issue costs. So if we've issued debt or equity, we'll have issue costs associated with that. If there's a debt issue, we'll get tax relief on it. If we've issued equity, we get no tax relief on those costs. So those costs will be a cost to the business, and we did those in illustration 2. Do also note that sometimes the question will say that we need to raise the costs as well as the actual amount of financing, i.e. we don't have the costs available to us, we don't have the cash to pay them, we need to borrow that money as well, which means we would need to gross up those issue costs. So we need to gross up the finance required, and we looked at that in illustration 3. The next step is to look at the tax relief on any interest on any debt. So if we issue debt, we'll pay interest on it, we'll have tax relief on that interest. That's a benefit to the business. So the present value of that tax relief we need to calculate and then discount it at the cost of debt given to us in the question. So one of the key things in APV is remembering what discount rate to use at each stage. So for the tax relief on interest, we discount at the cost of debt. Now we could also discount it at the risk-free rate. It doesn't really matter which one, but just don't discount it at your ungeared cost of equity that you discounted for your base case NPV. You either discount at the cost of debt or the risk-free rate for the interest payable on your debt. So we did that in illustration 4. Lastly then, look out for any cheap loans. We'll discount those at the same rate, i.e. our cost of debt. If we get a cheap loan, a government subsidy, something like that. But don't forget there'll be a benefit to that, because we would have had to pay a higher rate of interest if we didn't get that cheap loan. So we need to get the present value of the interest saved. And we did that in illustration 5. So that was the 3 steps: base case NPV, then the 3 steps: present value of the issue costs, subtracted because that's a cost, Present value of the tax shield added on because it's a benefit, and the interest saving added on also. That gives us our APV. And always look in a question to see whether the examiner is trying to confuse you by giving you a negative base case NPV. Don't get confused with that, because these other things, the financing side of things, may well make it positive. So if you see a base case NPV that's negative, don't be thinking you've calculated it wrong automatically. Get your APV calculation done and then assess the results. So we did that in illustration 6. Do note a couple of just theoretical things for APV. First of all, the project may increase the company's debt capacity. That's because that project could act as security for them to raise more debt. So they could raise finance against that project. So the company may raise a certain amount, but the debt capacity may be increased by more than that. So if the company may raise 10 million, the debt capacity may be increased by 15 million. Use the theoretical debt capacity, i.e. the 15 million, not the actual amount, for the present value of the tax shield calculation. It's quite a rare thing that this will come up in a question, but make sure you look out for it. So always use your theoretical debt capacity for the present value of the tax shield calculations. So that was a recap of our lecture on APV.